The market for Nuburu Inc., ticker symbol BURU, closed on Friday, November 28, 2025, at a price of $0.24 per share, marking an increase of approximately 9.85% for that session. This particular move is an immediate insight that should grab your attention, because the expectation for a stock that is trading below $1 and carrying the .BC designation on the NYSE American, a mark indicating non-compliance with listing standards, is usually continued downward pressure or sideways consolidation. Instead, we see a nearly double-digit percentage pop on the final trading day of the week, driven by a notable volume spike of nearly 29 million shares, significantly higher than the typical activity. This suggests that despite the very real financial and corporate governance concerns that the broader market has priced in, there is a distinct, active contingent of buyers who are reacting to the company's recent strategic pivots, specifically the push into the defense sector and a new recapitalization effort. The tension here lies in the market's expectation of fundamental weakness versus the opportunistic reality of trading around corporate news and low-float volatility. The general belief swirling around Nuburu right now is one of distress. This is a company known for its blue laser technology, an area with legitimate industrial potential, particularly in welding and 3D printing of reflective materials like copper and aluminum. Yet the balance sheet tells a story of acute financial struggle. The Q3 2025 report hammered home the reality of a substantial doubt about the company's ability to continue as a going concern, a net loss of $22.4 million with zero revenue, and total liabilities significantly outpacing cash reserves. This kind of financial profile naturally forces out institutional money and attracts a skeptical crowd, leading to the stock price sub-dollar price. However, what the retail investor must internalize is that this belief, while fundamentally sound from an accounting perspective, is precisely what makes the stock a high-wire speculative trade. The contrarian take is that the company is fully aware of its predicament, and its recent string of announcements, the creation of Nuburu Defense LLC, the joint venture with Techne.SPA, and the planned acquisition of Orbit.SRL for software integration, are not mere window dressing. They are aggressive, last-ditch efforts to dramatically restructure and re-rate the business model, shifting from capital-intensive commercial lasers to a potentially higher-margin defense and security contractor model with recurring SaaS revenue. The recent stock movement itself is a direct reflection of this corporate scramble. The stock has been highly volatile, seeing multi-day runs and sudden crashes, often on news releases detailing progress on the transformation plan. The September 29, 2025 strategic update detailing the $12 million public offering and the defense pivot served as a temporary floor, but the actual Q3 report in mid-November confirmed the worst fears about the core business's performance. The stock price action since that November filing has been a bumpy but overall upward grind from its 52-week lows near $0.12, suggesting that the fear premium has started to dissipate in favor of speculative enthusiasm for the pivot. The high daily volume, sometimes exceeding the average by a wide margin, points to a heavy churn of shares between short-term traders and those accumulating a position based on the defense tech narrative. The fact that the stock can surge 10% on a Friday with no immediate material press release suggests that momentum traders are tracking technical indicators and retail sentiment closely, anticipating the next corporate development. To truly understand the pressure cooker environment surrounding BURU, you need to be aware of the short-selling dynamics. This is not a classic heavily shorted meme stock, but it operates with a similar volatility profile due to its low price and high-risk fundamentals. The latest data available shows a short interest of approximately 17.7 million shares, which translates to a short interest as a percentage of float of around 4.12%. While this percentage might seem moderate compared to some stocks, the key actionable insight here is the days to cover, which sits at a very low 0.76 days. This metric suggests that short sellers could cover their positions in less than one trading day based on the average daily volume. This low days to cover figure actually cuts both ways. It indicates a low risk of a massive uncontrollable short squeeze, as there is little structural constraint on shorts exiting. However, the high daily short volume ratio, which has recently been reported well over 50% for off-exchange trading, reveals that a significant portion of the daily trading action is short-side selling. This aggressive shorting, largely happening in dark pools, reflects the short seller's conviction that the company's financial state makes its strategic pivots non-viable in the long run, and they are actively using high daily volume to suppress any price rallies driven by retail enthusiasm or news releases. Investors need to look for two main signals here. First, track the short borrow rate, which was recently quoted around 5.07%. A sharp, sustained spike in this rate would signal increased demand and a potential supply constraint on borrowable shares, the first real sign of squeeze potential. Second, monitor the fail-to-deliver data, though this updates slowly. Any large, persistent fail-to-deliver figures would suggest settlement difficulties and potential naked shorting, a contentious topic often debated on platforms like Reddit and X. For now, the narrative is that sophisticated short sellers view BURU as a failing entity with a speculative lifeline, and they are willing to take on the day-to-day volatility to bet against the long-term success of the turnaround. What's your take on the rising off-exchange short interest? Smart money pushing a valid thesis, or an overly aggressive bet against a company with legitimate defense contracts in the pipeline? Comment below how many shares of Nuburu you currently hold, or if you've ever traded a stock with the .BC designation. The foundation of Nuburu is its intellectual property in high-power, high-brightness blue lasers. In physics terms, blue light is absorbed far more effectively by highly reflective metals like copper, which is essential for components in electric vehicles and energy storage. Traditional infrared lasers simply reflect off these materials, making welding slow and prone to defects. Nuburu's technology solves a real-world manufacturing challenge, and the blue laser market has a clear long-term growth trajectory in advanced manufacturing. However, the business model has historically suffered from the high capital expenditures required to scale laser manufacturing and the long sales cycles involved in industrial adoption. Older reports showed promise in testing phases, but translating that promise into consistent, large-scale commercial revenue proved difficult. The company's past performance has been characterized by consistent net losses and recurring need for financing, which led to the drastic operational and financial impairment charges seen in the latest 10Q filing. The dual CEO structure and the series of proposed acquisitions are symptomatic of a total reboot, an acknowledgement that the original business model could not sustain the company. Looking ahead, the future outlook is bifurcated, tied directly to the expectation versus reality framework. The expectation is that the defense pivot will fail due to lack of scale, capital, and a proven track record in that heavily regulated sector. The market expects the company to burn through its recently raised capital, continue to incur substantial losses, and ultimately face delisting or bankruptcy. The reality, however, is that management is securing small but meaningful contracts, such as the one supporting Techne's $6.6 million international government deal. The defense and security focus, coupled with the plan to integrate Orbit's SaaS platform, attempts to address the two core problems: slow commercial sales cycles and a need for recurring high-margin revenue. The catalysts for a potential upside move are clear: a finalized, substantial contract through Nuburu Defense, especially one tied to a major NATO client, or the successful consolidation of one of the announced acquisitions, providing immediate, recognized revenue. Conversely, the risks are equally stark: failure to secure that high-profile contract, continued widening of net losses,
or, most critically, an inability to secure follow-on financing under the Standby Equity Purchase Agreement, SEPA, without completely decimating existing shareholder value through extreme dilution. The fact that the NYSE American accepted a compliance plan through October 29, 2026, provides a defined, albeit generous timeline for the company to demonstrate a return to compliance, a deadline the stock will trade around. Investors need to watch for updates on the Techne Joint Ventures contract pipeline and the Orgut acquisition status, as these are the tangible steps that bridge the gap between speculative hope and corporate execution.